All right. Good morning, everyone. I am Gershon Margolis. I am the founder of Imperial Advisory. We are a team of senior CFOs and financial executives who serve as part-time CFOs and consultants for businesses that need strategic financial leadership, but who don't need a full-time CFO. We focus on helping CEOs and CFOs solve complex financial challenges. For CEOs, we provide high-level financial strategy, assisting with growth planning, M&A, financial operations, basically sitting in the CFO's seat. For companies that have a CFO, we acted as an extended team and we provide tactical and or strategic work on FP&A, cash flow forecasting, audit readiness, transaction and due diligence support. And we do that again for CFOs that often are on top of the game, but sometimes have some, you know, holes in the team beneath them. Typically, we'll work for one of the following two profiles, either a smaller company, let's say 20 to 30 or more employees, whose CEO is typically the owner and is challenged to deal with kind of being their own CFO. And so they're busy running their business, but they're also kind of their CFO. That's one profile where we come in, we help, we provide a lot of value. And the other is a CFO at a larger company. Frequently, that's going to be 100 million plus or $100 million plus division, though certainly could be smaller. And again, those people need FP&A support, audit readiness, some kind of consulting, and that's where we jump in. Our value lies in in our ability to provide customized financial solutions and to drive growth and operational efficiency. And that's where we help. Anyway, um, that's kind of my introduction to the firm. I want to welcome all of our guests, all of our teammates, and especially our three speakers today. So today we're going to start with, I'm going to start by introducing our speakers, and I'm going to let them each give us, a short intro of themselves, and then we'll jump into the questions and the program. So first speaker is Mendel. Mendel runs a CPA firm called Shapira CPA in Brooklyn. Our second speaker is Av, who is an M&A and corporate attorney. And the third speaker is Rick, who is one of our CFOs, who's got many decades of experience. We're excited to have you all. So first, Mendel, want to take a moment to introduce yourself?
Sure.
And then,
Thank you very much, Gershon.
sure.
Thanks for having me. So Mendel Shapiro from Shapiro CPA. We're an accounting firm. We help clients be more bank and exit ready. So if you want to get a line of credit or any financing, we'll help you present yourself to the bank. And if you're thinking about a sale, we'll prepare you and make sure that your financials tell your story, so you're more presentable. We've been in the space for 18 years now. We have a heavy focus in the manufacturing space, which is why we talk a lot about manufacturing. Although we have clients in different industries as well, manufacturing is one of our specialties, as we see manufacturers being helped a lot when it comes to help them be more bankable and more exit ready.
Thank you, Mendel. All right,
Hey everyone, good morning. My name is Ab Sinensky. I'm a partner in the corporate practice at Falcon, Rappaport, and Berkman. We're a full service law firm based in New York with a headquarter office in Long Island. My practice focuses on mergers and acquisitions, both on the buy side and the sell side, focusing primarily in the middle market and lower middle market. I would say that My favorite part of my practice is when I have the opportunity to work with founder-owned businesses or family-owned businesses and help navigate them through an exit. So looking forward to talking about some of the best ways to do that today.
All right. And Rick, you're up.
Good morning, everybody. I am a retired full-time CFO from 40 years in the United States and another 10 in South Africa. You could hear from my accent. And I've had a concentration in the manufacturing and quasi-banking sectors, also covering distribution. I've worked closely with CEOs as their right-hand man in the business, primarily owners, as previously people have mentioned. And I've joined this Imperial Advisory because I want to continue to contribute and help owners and CEOs grow and do what they want with their business. And I'm looking forward to discussing this morning.
All right. Thank you all. I'm going to take one moment to welcome some other people from our team who are here. Thank you, Tony, and Elizabeth for helping put this together. And thank you to all the people from our team who are here, and the ones whose names or faces I see are Dean and Marty. So you both get a special thank you. And without further ado, let's get going. All right. So our topic today is how to build a sellable business. So the first question that we're going to ask is, why do we care? Why do we need a sellable business? And why is that something that people, the business owners, so that's whether we have business owners on the call, whether it's you, or we have advisors on the call, some of your clients, why is that something that we should aspire to, or that a business owner should aspire to? So, why don't you get us,
Yeah.
started here?
Yeah, I mean, it's a question we get a lot because a lot of business owners say, well, why do I care if my business is sellable? I'm not selling it. I want to own it. I plan on holding on to this for many years. Maybe my children will take it over. Um, but the reality of the matter is that your business is for sale, whether you think it is or not. First of all, you just have no idea what the future is going to bring you, whether that's for your business or for yourself. Things happen, circumstances change, life gets in the way, for better or for worse. And if none of those things happen, if somebody shows up with the right offer, just like your house is for sale for a number, your business is likely also for sale for the right number. So it behooves you to be in a position to have the ability to sell your business if something like that unexpected happens. Um, Moreover, even just putting aside, extraordinary circumstances, having a business that is sellable gives you options, and optionality is something that you shouldn't take for granted. Having the option to either hold on to your business and continue to pocket the cash flow, or to exit and pocket a larger check in one shot. It's not bad to have those options. Um, the fact of the matter also is that the types of things that make your business more sellable, generally speaking, will also make your business more profitable and valuable to you. So this isn't a zero-sum game where focusing on sellability is going to impair your short-term value or your value of holding on to the business. It's almost a mutually beneficial um, exercise to go through. Before I turn it over to Mendel, just the last thing I'll say is that kind of, t- building on that point, is that a lot of times going through the process, or even thinking about how to prepare your business for sale, will lead you to discover flaws in your business or things that you could do to improve your business that you wouldn't have necessarily encountered or thought about if you hadn't gone through that exercise. So even merely just the exercise can add value to your business for yourself, even absence a planned sale. So that's kind of a high level. I think we'll probably dig into some more of these concepts over the next few questions, but Mendel, turn it over to you.
Thanks. I see you're coming from the perspective where people are already reaching out to you and say, why should I sell my business? I'm coming a little from a different mindset. When I talk to people about this, it's like, I see this in two groups. When I saw the question, there were two groups that came to mind. I guess from my experience is there's a group of people who say, my business is profitable. Why would I sell my business? Why would I even think about it? It's not like, why would I sell? Why would I even think about selling my business? I have a profitable business. And then you have a group of people that say, yeah, it's something that I can think down the line, but I don't see that something for today. So why should I prepare for it? So for the first group of people that not even thinking about a sale, similar to what you've said, Av, building a business that others want to buy is a healthy business. It's giving you the optionality, as you mentioned. It's options for financing, it's options for partners, it's options for investors. So all these options are being created if you build a sellable business. And for the group of people that say, yeah, this is something that I would think about it down the line, just not for today. The best time to prepare for a sale is when you're not in a sale. So you don't have the pressure. You're not trying to impress anyone. There's no transaction going on. Now you have the mindset of focusing. How do I make this a healthy, sellable business? That is just the best time to do that.
All right. And I'll just throw in a small anecdote. I had a conversation with a friend of mine who was running a large, many hundreds of millions of dollars, a large business, and we were talking about the idea of best practices and having things be done right. And he kept poo-pooing that. And then a few months later, I was having a conversation with him, and he had been approached by buyers with a very high number, but didn't have he had grown fast. He didn't have the underlying infrastructure to enable him to sell. And it was sure he got cash flow while he was running it, but you know, you know, I've focused more on this. But like when that comes up, but you want to be, you want to have the options, I guess, as you really both mentioned. Um, in the end, he didn't sell. Um, all
But at
right.
least you have the option, right?
Well, he didn't have the option because he didn't listen to me when I was the best practices guy, and he was like, I don't believe in best practices. I don't know. I didn't like go back to him to ask afterwards if he believed in them. I tried to help him at the time, and hopefully we helped a little bit at that point when they were looking at the sale. But in the end, I think that whatever I'm sure it was a variety of factors why they didn't do it, but certainly would have hurt his valuation, no doubt. Um, not having the house in order, so to speak. Um, all right. So, another question for Ob. How do buyers evaluate risk beyond numbers? So, right, we got Mendel and Rick. I'm sure we're going to hear a lot about numbers from them. But what else should we think about? And also, just like a little curveball, how much of this stuff is really doable way in advance?
Yeah, those are both very good questions. My portion of representation often has to do with specifically that assessing, evaluating, allocating risk beyond the numbers. When a buyer looks at your business, the first thing they're going to do is look at your numbers. They want to see, is this business profitable enough? Is it financially sound? Does it make sense? And if they conclude that the answer is yes, and they construct an offer based on those numbers, the next question becomes, and a lot of the subsequent due diligence will focus on, is there anything outside the four walls of those numbers that isn't showing up in the financials, that we can't glean from the numbers, that we need to understand about this business, that is kind of like an off financial statement risk, off financial statement opportunity, something about this business that can't be captured just by the numbers. And things like that include the nature of your contracts, for example. And when we talk about contracts, we're talking about contracts with customers, contracts with suppliers, contracts with key members of your management team. Are these relationships that you have merely arrangements where, we call up our suppliers and we order product when we feel like it, when we do the same thing to our customers? Or do we have binding long-term written contracts with them? Um, can we count on the business from these customers to recur? Are they locked into certain pricing? Are these contracts able to be transferred as part of a sale? All of these things really go to the actual value of those relationships, because I can see in your numbers that you generate X dollars in sales a year, but if I have no assurance that those sales are going to continue after I buy your company, then what have I really bought? Um, those are the types of things that you absolutely can tackle head on way in advance of a sale. And it's exactly the type of thing that I was talking about earlier when I said these are the categories where you could actually enhance the value of your own business by being thoughtful about our relationships. Are these things that we actually have binding commitments on, or are these handshakes that anyone can walk away at any time if if the relationship's ours in some way? Um, Similarly, things like making sure that you have good corporate documentation, that if you have multiple owners, that there's a operating agreement or shareholders agreement that governs how operations work, that governs what steps will have to take place in order for a sale to occur. Does it have to be approved by a board? Does it have to be approved by all of the shareholders? Can the one of the owners unilaterally act? These are the types of things that you want to make sure you have a good understanding of before you get to a sale, so that nobody else has a reason or leverage to try to extract something, and because they can hold up something. Um, and like Mendel said, making these arrangements outside the context of a sale is always advantageous, because then you're not doing it with a gun to your head. You're not doing it with time ticking. You can do it on your own schedule, on your own terms. Nobody feels like they have leverage to extract something from you because you need them. And these are the types of things that you really can deal with well in advance, and absolutely should, regardless of any sort of contemplated future sale or just wanting to have a healthy, sound business that can operate smoothly.
All right.
There's
Thank
some
you.
other risks. There's some
Go.
other risks perhaps that should be mentioned. There are how your labor team runs your benefits, and whether you are following all overtime rules that apply today. There's a whole labor side of it that needs to be checked. Also, in terms of insurance, workers' comp insurance is a big area where you don't want to get involved in a company that has had a lot of claims in that area, and it's a problem if you do not cover that up front, and including even your general P&C insurance, where if you've been had issues and having claims, it's another area where a buyer would want to make further investigations in terms of a risk factor. Those are also pretty important from the legal side.
Absolutely right. Yeah, I mean, I didn't even touch on that, but yes, anything to do with regulatory compliance, anything to do with potential litigations or disputes, those are precisely the types of things that would never show up on your balance sheet, right? If somebody's out there saying, I'm going to sue you for $10 million because you screwed up my project, you don't have to then go and put a $10 million liability on your balance sheet, but that's a real potential liability that might come to pass. And obviously a buyer is going to need to know about that. And as well as all of the liabilities and extra risk that can come from compliance issues that need to be examined carefully, and should be examined carefully whether you're selling or not, because those risks are ones that you will bear if you hold on to your business.
I think it's worth mentioning non-compete and key member or key employee contracts as well. Those are also pretty big items that should be done early on.
Yeah, absolutely. I mean, I think we're going to talk a little bit at some point about, owner dependency as being a key thing that can drive down the value of the business. The idea that when someone is buying your business, they want to, generally speaking, acquire a business that doesn't require the owner's involvement, relationships, at least at the same level as it did when he was, the sole owner or the manager. Um, and having in place a management team that is retained pursuant to binding agreements, that is motivated to work through a sale and after a sale, is paramount for a buyer in that situation, who wants to make sure that when I buy this business, it's going to be able to just keep operating day one. I don't need to now go out and hire a new CEO and a new CFO, all sorts of people to come and actually run this business. They want to buy a business with a management team that's already in place, that's aligned, that is motivated to grow the company and make it profitable for buyer.
All right. Before we jump into the next question is about financial related things. I have a poll that I'm supposed to be doing that I forgot to put up. So if everyone can just take a second, answer just 3 quick questions. 1, how did you hear about this? And 2, things that are slightly, more descriptive of your situation. Give you give a few seconds for people to answer that. And then we will keep going in a second. All right. So we're going to keep going. We'll leave the poll open for another minute, but we'll jump to the next question. All right. What are the key financial indicators needed to maximize your price? We're going to start with Mendel, but what are some of those things that you look out for? And I guess you can also add in, are there anything that there's some things that we notice, and there's the things we can do something about. So if you want to sprinkle in which are the things that are easy to fix, and maybe which are just the things that require longer term thinking.
So first, when you talk about key financial indicators, the first thing that comes to mind is very often you see you have a business owner that tells you the story of the business. It's a beautiful story. They tell you how they operate, how they're profitable, and everything about the company. But then when you start looking at the financials, you get a different story, and there's a gap between what they're saying and what the financials are saying. So that gap creates a certain uncertainty. And the KPIs is really what's bridging the two together. Meaning to say, if you have a story and the KPIs are the indicators telling you whether your story holds through, that keeps you in line and keeps you in shape. And if something is not indicating to the right direction, it's going to help you and push you to the right direction. So when thinking about specific KPIs, I would probably split it between the P&L and the balance sheet. On the P&L side, you want to look at profit margin. You want to see a consistent profit margin. If your profit margin is not consistent, something is wrong in your system. The display is not the way it should be. And that's why we have the KPI set up to tell you that. EBITDA is a big one. You want to know what % of your sales stays over in the bottom line. The bigger that number is, the healthier the company is. It means the company doesn't need that amount of output to generate profit. So EBITDA and EBITDA percentage is a strong indicator. And the next thing on the P&L is the debt service coverage ratio. You want to make sure the company has enough profit generated to cover the debt that they have. So those are indicators that tell you the healthiness on the P&L side. When it comes to the balance sheet, the things I would look at would be the turnover ratios, which is the AR, accounts receivable. How many days does it take for you from when you have a sale until you actually get paid? And the simple logic in that is, if it takes you 20 days to get paid, that's the amount of cash flow that you have outstanding. The longer the period, the bigger the cash flow gap becomes. Same thing with inventory. The inventory turnover ratio tells you how many days your inventory sits on the shelf. The longer your inventory sits on the shelf, the more cash outlay you have, and that could create a constraint on cash flow. And last but not least is the AP turnover ratio. The longer period you have that you can pay your vendors, that creates more cash flow availability for yourself. So those are the things that you would want to work on and create for yourself a healthy, not only measurement stick, but healthy numbers that, whether it's 30 days or 45 days, depending on the industry, those are the numbers you want to focus and shift on to make sure you're hitting those numbers. There's one more item that may be a little more for Rick. I'll leave that over. That's the CapEx. That may be a little more technical. That's also an important indicator.
That's a good point. I was actually going to ask, but maybe I'll wait till Rick is done. I was going to ask about EBITDA, especially in the manufacturing context. EBITDA can kind of potentially ignore a lot of CapEx because it's not considered an expense now and it's backed out of profits later. But all right, we'll leave the hard. We'll leave that for Rick. But I want to ask you one quick question, Mendel, on what you were saying. We were talking a lot about the ratios. Are you looking at absolute ratios and saying like it needs to be X, or are you looking more and saying, well, it used to be X and now it's, your accounts receivable is going up and therefore I don't necessarily have a problem with it the way it is, but why is it getting worse? So are you looking more at trend analysis or more at like, this is how a business should be?
No, obviously you want to put some logic to KPIs, and you want them to represent the company. So it's not like this is what it has to be, and this is the way it should be. It should explain the trend of the company. So if you see your accounts receivable going up, you would want this to be a result because your revenue went up. If the accounts receivable went up when the revenue did not go up, that's an indicator that it just takes more days to collect your receivables. So that's what I'm saying. It's not just an absolute number. You want to see the trends, what's causing it. Obviously, you want to see consistency first, but you want to see improvements and you want to see alignment between one indicator to the other.
I would actually go further and say you need to have a targeted number. Because if your sales are growing, your accounts receivable are growing, your payables could be growing, your inventory could be growing. So to manage the interplay of the three, you really need to have a target. If 46 days has been your regular number, you should stick to at least 46 days. Otherwise, if you're letting that stretch and you're growing, you're really going to have a big cash requirement, which you may not be ready for. So I think it does have to have an absolute target that you're aiming for and you try and manage to. And if you're not succeeding, you know you're going to need more money. You have to go to your bank at that point, or if you're cash rich, I guess you cover it. But I think that is important, managing those numbers.
I want to jump in for a second, Rick. Potentially, even if you're growing and you keep it at 46 days in your example, you could still end up in trouble if you're not
Correct.
doing a proper, forward-looking cash flow because
Correct.
it's 46
Absolutely.
days of a larger revenue number.
Yes, I'll try to indicate that as well. Yes.
Okay. So what else? What else do you have for us, Rick, in terms of financial indicators?
Here we go. So first of all, normally, and again, it depends on the size of your business, but normally you need to produce a 3 to 5 year history showing your growth over the period, your consistency over the period, and some of the numbers beyond sales will become important. And then you're also looking perhaps to a 3-year projection on your revenue. So once you start with that, you've got to look at how much recurring revenue you've got and how much new revenue you have to produce. And that creates questions about your how you sell in your pipeline and where your future sales are coming from. Going beyond revenue, you're going to profit. So there are 3 areas there that I would look at. Your gross margin is very important, especially in manufacturing, because your gross margin is going to give you your margin over your direct cost, which is mostly labor and, more importantly, material. And if you can maintain the relationship of selling price, material, and labor, then you are showing a constant management level that can handle all your overheads below the line. If you are growing sales and your gross margin starts dropping, you are buying sales at lower margins, which can, in the long run, be very poor for a buying point of view. EBITDA is also very important, of course, as Mendel mentioned. And for a buyer, I believe you need an EBITDA of at least 10%, and maybe your business can do 15 or even 20. But if the EBITDA number in a percentage term to an investment is not there, then there is no point in wanting to buy the business. So benchmarking generally in the M&A business is round about 10 to 15. And, there are businesses, of course, that make much more, if you're in IT, for example. But the other area of EBITDA as an owner that you have to consider is what I call lifestyle expenses. When you own the business, you may be doing more travel, more entertainment, have a better car. You may be having expenses that a buyer would not consider normal, and that can be added back to your profit. So you would have an adjusted EBITDA covering those. Very important to look at that up front. It's very important that the first look a buyer gets is the right look. If you are changing numbers along the line, very quickly, your whole credibility suffers. Very quickly. And a deal can disappear very fast if things change, if this is proven to be incorrect, if the quality of earnings doesn't match your P&L accounts closely enough. As far as the rest of the P&L goes, I would look at material numbers only. There are other material numbers that can change. Some of them, perhaps, are sales and marketing. You need to have a target total and work within that number. And you don't spend more to gain business than you earn from the business. Something that, if you're in the IT business, is very complicated to calculate. But in manufacturing, it's very straightforward, or distribution as a reseller. So that is very important as well. But I would look at perhaps any expense over 10% worth looking at closely. You may need answers if there are changes of those numbers, because a buyer would look at that. He would look at where the risks are in terms of the actual numbers. Then above that, really, it's in terms of being consistent. If there are cycles in your business, showing them on the monthly history and look forward, know the answers to those peaks and valleys if they exist, that they come every year and go every year. If numbers start changing, you're going to have answers. The very important thing is that what you show a buyer stands up to any curiosity, any test. You can't change your mind midfield. It is a disaster in terms of keeping a buyer. So those basically are the financial matters, that I would look for. KPIs can get deeper. Your labor percentage. There's inflation out there. Sometimes labor costs change dramatically, as we've seen. Minimum wage levels. If you have entry-level people, they may be on the minimum wage. That can jump on you. How do you counter that? Efficiency and productivity are keys in the long term. Finally, the capital expenditures that Mendel said I may talk about. If you're a capital-intensive company, you've got high capital investments. How old are they? How long are they going to last in the future? Is their productivity suffering, or are you falling behind in competition because others have better capital equipment today? Very important as you move forward. And the replacement cost is nowhere near what you originally paid. Be cognizant of replacement costs. Check them, even if you're not buying today, because your buyer will probably look at that if you have old equipment. Benchmarking is very common when a buyer looks at your business. He wants to see what others are doing. And you've got to be at least at benchmark, if not better, if you really want to get a good price. So that's also a key in terms of the basis of your business. Even if you're in other businesses, construction or whatever it is, you've still got material, you've still got labor, and you've still got inflation, and you've still got replacement. Those are big factors.
I
Rick, if
want
I
to
can just add, sorry, go
go
ahead.
ahead.
I was just going to add on the CapEx side, when the buyer looks at capital expenditure, they basically would want to answer the question, how much reinvestment do we need to keep the business operational? And as you mentioned, some of those machines might be outdated and we just need more money in a year and 2 years to just have the company in operation or stay afloat. So that's another measurement stick for the buyer to figure out how much additional investment will they need down the line to keep the company going or growing.
Absolutely.
You could say almost that there's two kinds of capital expenses. There's all kinds of things that might qualify as capex, but they're almost like keep the lights on. And then there's those big major investments, which maybe there's an argument should not be included. Those are more optional, more longer term investments, and not just keep the lights on.
Right, but from a buyer's side, they have to look at both. And if I want to tame down a little bit what you mentioned, what you can or nice to have, in some cases, if you don't have up-to-date machines or if you don't update yourself, you're just falling out of the game. So it's not only a nice to have, it's almost a must have, maybe not today, but in a year or two today. So that is part of the mechanics and the calculations they'll be making when looking at this.
Right. And for anyone who's familiar with Charlie Munger, who passed recently, you can Google Charlie Munger and EBITDA to see what he thinks about that and how it.
The value of EBITDA, yes.
Yeah, I'm not going to use the term that he used, but he doesn't think that EBITDA really is reflective of reality, specifically because of what Mendel's saying. Right? You don't have to buy it today, but you're going to have to buy it in a few years, and you just systematically ignore like a major part of what your business has required and will require, and how is that really meaningful earnings picture. But anyway, do that after the webinar. Google Charlie Munger and EBITDA. I have a quick question though, and this is really for all three, for any of our guests, whoever wants to jump in. Rick mentioned that 10% EBITDA. If you're not earning 10% EBITDA, don't even try. My question is, there is this whole concept, and you know, Rick, you're at least a few years older than me, so you've probably seen this, like where people, I mean, I'm sure you've all seen it, but I feel like it went on more a while ago. But anyway, there's this concept of buying companies and turning them around, right? And so the question is there, like, don't people also buy, or how do buyers react to very low earnings? Is there really no way to sell them, or is it just that you're not going to get whatever you think is a reasonable multiple on your earnings because it's clearly an unhealthy business? And so,
Yes, in fact, both those factors are true. And again, if you're looking at a financial buyer, those numbers are much more important. And unless they see obvious areas where you are, let's say, call it just wasting money, or you're too cheap in the marketplace, they may know how they can fix that, and they'll offer less and then make it up on their own. The other area is a strategic buyer, where you're not the platform for future business, but you're being added to an existing business to gain market share or gain other attributes that your business has. And there's a lot of extra room for them to take out some of those expenses as part of a merger and still make the required bottom line from your part of the business. And that is quite common in the PE market, where they will pay more if you're doing well, but may give you the same as the other people, the financial buyers, on a lower margin. So that is a whole, individual circumstance situation. And I think there are a lot of variances there. Of course, you want to go back in time, interest rates have gone in all directions over a period of time. So the 10 to 15% kind of survives all of them.
Mm-hmm. Mendel, anything you want to add to that? Or
Yeah, what I would say is the conversation we're having today is how do you build a business that's sellable? And you want to build something that's healthy and sellable. That's the plan. That's the direction you should go. I think no one disagrees over here to say that there's no possibility to sell a business that's below 10. You can always find unique situations where a buyer has an interest for a specific reason, either because strategically it works for them or for whatever other reason, but it's not something you should plan and work on. This is not something that you're building up. If you're building a business that others want to buy, you want to build that business that impresses other people, and you have more options. And by far, you're getting a lot more options once you hit that 10% mark and up, because there are more people interested, and they have more ways of how to build that business and continue growing it, as opposed to if you find a unique case where someone would buy a business that's lower than the 10% mark.
and to your point, Mendel, I know that there are certain target EBITDA, like absolute numbers, where when you get past a certain point, you end up in the whether you now become eligible for private equity or whoever and whatever, you can sometimes have a totally different set of buyers.
Yeah, I just wanted to chime in. I think the fundamental perspective that a seller always needs to have, and like I think it's germane to this point, but I think makes sense in general, is that when a buyer is looking to buy you, they are obviously looking at your past, but what they're buying is your future. They're using the past to try to build a predictive model of the future. But in your case, where maybe the earnings are not quite there, if the buyer can be sold a story of how they're getting involved, they're putting in resources, them, cleaning up operations in some way will create future value. They may not pay you full price for that, but it doesn't make your business unsellable. There needs to be a turnaround story that a buyer can be told. And the flip side is the opposite. If your business is making money hand over fist, but a buyer sees problems with the future, whether that's something in the market, something innate to your business, something about their ability to actually operate that business, that just, the past doesn't matter if the future is not going to follow in whatever story you're telling the buyer, whatever story the buyer is seeing there.
Got it. Thank you. We actually had a situation not that long ago where we were working with a buyer. The seller had little to no EBITDA, and they really didn't have a story. They had figured out how to grow sales really quickly. They were probably close to 10 million in sales, but they had no real profit to talk about. And they tried firing their whole sales force, and they're like, "Oh, okay, well, it'll be profitable next year now that there's no sales force." But it's like, okay, but how are you going to grow, and who's going to maintain all those relationships? But at the end of the day, I mean, we were working with the buyer, and we were helping. We were kind of coming up with the story, and eventually, the buyer's like, "Look, we're not paying you to come up with the story." They had to come up with the story, and maybe they did lose money, but they need to articulate what was it. And by the way, they had gross margin erosion as well, so it wasn't like it was clear that growth was even working for them. Um, even if they did fire the whole sales force and get rid of a bunch of other overhead, or what they viewed as overhead. But yeah, I mean, the seller really needs to have that story, and to Rick's point, be able to defend the story in order to make it's not just having the story; it's having it and really selling it. All right, let's see. I guess we have time for another one or two questions, and then we will maybe we'll take a few questions from the crowd and set up next steps. All right, so question is, do we really feel like we covered this one? The next question was for you. What story does a buyer need to believe in order to pay a premium?
Yeah, I
Any
mean,
more to say on that, or just
yeah, I mean, it's kind of what we just talked about. It's, you know, will this business continue to perform as represented, right? Um, a buyer is looking for certainty. The, the opposite of certainty is risk. Um, if there's risk, then I'm not going to pay you as much for a business that I feel good about. And a business that has value is one that reflects on paper what the owner is selling in that story, right? A lot of the due diligence is an exercise of trust but verify. It's an exercise of show your work. It's saying, okay, you're telling me that you have a clean, healthy business. Open up your books, open up your contracts, open up everything, and let's find out. And very frequently, the process itself can be what makes a buyer feel good or not as good about your business. You know, when a buyer starts asking for documentation, for numbers, for backup, are they handed over within a matter of days, or is this an elongated process where seller is tracking things down for a long time? That never gives a buyer a good feeling that this is an organized, well-run business. And those things tend to carry over. You know, people who run a tight ship generally have their house in order. It doesn't take them 4 weeks to locate the stock certificates to show that they actually own the company. When you start doing due diligence, are you finding that key pieces of IP that this business relies on are actually owned somewhere other than the company, whether it's in one of the owners, in some former employee who was a developer or something like that? And now, is this going to create additional friction, additional risk to A, getting the deal done, and B, if we get our deal done, to actually owning what we think we own? So it's all a lot of, you know, it can feel artificial and aesthetic at times, but you know, I think the model of buying a house is apt. You know, every even rookie real estate broker would tell you, if you're putting your house on the market, mow the lawn, paint it, you know, make sure you clean the house before people come to look at it. Does that actually affect the house? No, because the buyer could mow the lawn and clean it up when he gets there. But it's psychological and it's real, and first impressions make a really important consequence. So it's just really important to be mindful of. You only get one chance for your buyer to look at your business for the first time, and if they sour immediately, then it's going to be very hard to unring that bell.
Got it. Thank you. All right. So let's get one more. This one we're going to ask really all of you. So and I think after this we're probably going to take some questions from the crowd. We'll see how much time we have left. Um, what are the biggest red flags? And this really relates to what I was saying. What are the biggest red flags that fail the initial buyer sniff test? Like, what are those things besides all the things I've just said? I guess maybe we'll start with Mendel and Rick. What are the
Well, we already mentioned, you know, the fact that your numbers as presented up front have to be the same numbers that you live or die by. You can't change them. If there is anything you put in writing and then afterwards the QOV says, well, that's not the case, I mean, you've lost your credibility. Anything like that is a red flag. Any past legal action is a red flag. And any outstanding legal action the seller would have to attest to. So it's very important that those are covered. That you can maintain your management structure. As said previously, you know, the owner needs to have a team that can do the job without him. Sometimes buyers want a contract for the owner to stay on for a period to cover that issue, but not always. And sometimes the owner wants to get out and go, you know. So it's important that the team left behind can manage the business, and they may interview some of them. So there's a red flag if you have people leaving or not, people who are unhappy. I'll leave others, perhaps if somebody else wants to comment.
Yeah, first of all, obviously, we all agree to that. The financial gap, which we mentioned, if you have a story about your business and the financials show something else, that turns buyers away. You want to keep that consistent. You want to gain and earn that credibility by saying your story and actually showing up on the financials. So that's definitely number one. The concentration, which was also mentioned, but I think the concentration is not only owner concentration, which means that the owner runs the business, and if he's not here, the business just falls apart. It's concentration in any key area. If your revenue is created by 80% by one customer, that means when the buyer will do a what if analysis, it's going to just take out that piece of revenue, and that means we're losing 80% of the business. Thinking of a simple story we had 2 years ago with a client that had a very beautiful, profitable business, and we started looking into deeper. We found they had 40% of the revenue from a government grant that has just been created at that point. It was 2 years ago, and if the government decides to shut down that grant, 40% of the business is just not there anymore. So dependency on customer concentration, owner concentration, vendor concentration, all those things make a big difference. What I think is also worth mentioning is excessive distributions. When you see a business owner taking out a very big portion of the profits of the company, that tells buyers this is an unsustainable model. He's just liquidating the profits of the company. So excessive distributions is another big thing that I've seen being a big red flag.
Is that because it they're starving the business, or is that because even if the business, they give all the capital needed for the business, still just the fact that they're pulling money out rather than leaving it in, that means that if there's a hiccup in the future, the business won't have any money, or like what's
It
the
means
financial?
that they're basically trying to impress someone, showing that the company has healthy profits. But by the end of the day, he's not taking his proper salary, or he's not paying people properly, and he's just taking it out from a different angle. And the company is being cash thin, and not being able to have the owner continue running the business for the next 2-3 years if that's part of the commitment, because he cannot sustain his living. Cost of living or his style of living without having those excessive distributions. So it concerns the buyer from both angles. A, the continuation of the business owner staying on for the next 2-3 years. And obviously, if the buyer comes in, he's not going to be able to do the amount of distributions he did until now, which means he's not going to be able to continue serving the new buyer. And at the same time, it also tells that he's probably not taking the proper salary and just trying to show up on paper as a very profitable company, while being drained out from the earnings side.
Interesting. Thank you. Bob, anything you want to add, or should we turn it over to the crowd?
Let's go to the crowd.
All right. So we got a few minutes. We have 5 minutes now for Q&A. I'm going to put up a second poll, kind of asking you about future things, and if you'd like to speak with any of the people on the panel, if you are, please just take a second to answer that and jump in with any questions. All right, let's see. We got one question in the chat. I'll read that out. What is your experience in giving incentives to keep key employees?
We certainly have done that in various cases. Either a incentive to spend a period of time with a building incentive that gets paid at the end of the time, or even a bonus that is just for the next 12 months. But yes, it can be done at the right level, and some incentive into, if the person is important enough, perhaps the buyer would do something to enrich that incentive.
Have you
Yeah,
ever seen? Go ahead.
just to Rick's point, I would just add, incentivizing your team or your key members is part of your success. You can't do it without them. So you want them on board, and you want them to feel a reason to continue doing what you're trying to execute.
Yeah, and the important thing to know is also there's a lot of different ways to do that. You can incentivize through some sort of profit sharing, through a transaction bonus, through issuance of actual equity. There's a lot of ways to do it. There's a lot of tax implications involved in how you do it. So definitely consult with professionals when you do so, but it's not one size fits all. It really depends on what you're trying to accomplish, who you're trying to incentivize, and for how long and for what. And it's can be highly customized and tailored to your situation. So it's something to really look into if you have key employees that are vital to a business that are that you don't have tied down under some sort of formal agreement with proper incentivized alignment.
And just another plug. Thank you to everyone who answered the poll. Just take a second, please. Everyone, try and vote over there. It'd be very helpful. And I want to just share a small anecdote related to what we're talking about. I have a relative of mine who worked at a technology company, and they were about to go through some sale. And basically, I think maybe they were going to give some of the older employees, more senior or had been there for a while, had some equity. Other people didn't. And they basically ended up with a threatened strike. Like half the company threatened to walk out. And it's like in manufacturing, maybe you can replace the people. In a technology company, like the people are the whole business. And so if those people walked out, the business basically ceased to be able to operate. And they ended up kind of giving a deal bonus to all those people. And yeah, it's just there's the key people, but then sometimes depending on what your business is, sometimes all the people are in some way key, or at least when they act together as a group. All right, next question. Try one more. In a volatile market where contracts do not hold due to supply issues, as frequent force majeure tariffs and raw materials get increased, how does that show to a potential buyer, and if anything can be done to mitigate this?
I'm not sure I understand the question.
Well, I'll make a guess. Let's say you have issues that relate to supply chain things. I guess
In terms of how
maybe
does that show, I mean, the general answer to how does that show to a buyer across everything is, it's an important thing to think about, because most of what your buyer is going to know about your business is going to be based on what you tell them. And there's going to be a section in virtually every purchase agreement called representations and warranties, where you make a bunch of statements at closing about the nature of your business, such as, have you had supply chain disruptions? Have suppliers been able to fulfill their obligations to you? And these are not the types of things that you're going to be able to hide from your buyer before closing. So, as a general rule of thumb, I tend to favor disclosure, transparency. There's very few things that can't be worked through in order to get a deal done when both parties want to get a deal done. But when a buyer feels like they're being misled, where things are being hidden, where they are discovering issues that should have been brought to their attention earlier in the process, those are the types of things that could really erode trust and sink a deal when it didn't have to be that way.
If I can add, I believe the question is like, if I've mentioned in the beginning, you want to have contracts with your vendors, and if someone is in a situation where contracts are not a perfect fit because of the volatility or the supply chain issues, I believe as long as your profit margin indicates you have a consistent profit margin, which means you're addressing the up and the down of your costs, you will mention that you don't have contracts, you have volatility in your buying power, but you'll also indicate that you have kept your profit margin consistent. That's going to be the counter argument that how you're mitigating the risk of being in a volatile market.
Well, in fact, I
Right.
think most contracts where you are buying materials in the future, construction contracts, should have clauses in them in terms of material cost changes. I mean, in the last few years, construction costs the inflation has been very big, but people do complete the contracts, and and everybody, at the end of the day, has served what they had to serve. Un- Unless your contracts don't cater to that, it shouldn't be a problem. It's part of doing business today. Not so?
Thank you. Speaker, everyone, thank you all for joining us. We have a few more questions. I'm going to see if the speakers are available. Is everyone available to stay for a few more minutes?
Yeah,
Sure.
that's
Answer two
fine.
or three more?
Sure. Sure.
All right. So, everyone, thank you for joining. If you need to be in touch with any of the speakers, let me know. And you're all welcome to stay for a couple more minutes as we go through the other questions in the chat. All right. Any advice on enticing partners to buy out your share of shared client revenue in a professional services business?
Mm.
I guess that's like an accounting firm or a law firm where you have a few partners, each one has revenue that's kind of related to them, though it says here it's shared client revenue. So I'm not sure. Let, let's say two people share a client. Was anyone have any thoughts on that? Financial advisor. All right. So we have a financial advisor and we have a few, everyone's got a book of business. So I guess the question is, how do you sell your book to your partner? Shared clients. Anyone want to jump in?
I guess we have to do a cost analysis to see what percentage belongs to partner A, what percentage belongs to partner B, and there's a price to everything. So splitting up the value of customer A to partner A and the value of customer A to partner B will tell us what the future price for this is. Again, assuming that this is in a monthly recurring revenue type of business, which allows us to calculate the future revenue of that shared customer client.
And also assuming the customer stays after that particular shared partner leaves.
Correct.
Right. There are businesses where where it's in theory, uh, ongoing, recurring, either monthly or annual revenue, but that won't necessarily stay. And where often that's done with some kind of an earnout where people buy it, but they only pay based on the percentage of whatever of that book, so to speak, stays.
Exactly.
Um,
Yes.
Smaller accounting firms, Mendel, I don't know if you ever bought another accounting firm, but I think that smaller
Not
accounting
yet.
firms, if you're buying like an individual, like one guy's book or girl, then at least sometimes that's how they transact, where you're paying them.
Correct. They would first set a price that would be step one. And step two would be now we're taking a period, whether it's 2 years, 3 years, 5 years, and make an earnout period, assuming the clients stay on, and that's how the payouts go accordingly. But step one would be to determine a price, and I believe that was the question: how do we determine a price?
Oh,
And step two would be, to your point, creating some sort of guarantee for yourself.
okay. Yeah. Okay. So thank you. Let's see. What's the next one? What guarantees can be expected when there's an agreement for the owner to stay for a while and he's not giving what he promised? So I guess you can't fire him at that point. It probably doesn't help. How do we enforce
I
that?
think that the best possibility perhaps is a retention amount with certain provisions about performance.
So
Yeah,
he's not just staying; he's
yeah,
staying in exchange for.
and another thing that is often that what you want if you're going to have your owner continue, that's a fundamental question: is how are we going to continue to incentivize this guy? Right? He just took a lot of money off the table. Maybe that's all he needs. How are we going to keep him motivated? And there's a lot of different ways to do that economically. I mean, the private equity model is typically that you require owners to roll over a portion of their purchase price into equity in the future business or in a portfolio company that includes the future business and other businesses. So if, rather than getting his, let's say, $50 million payout at closing, he's only going to get 40 million, and that last 10 million is going to be wrapped up in equity or in some sort of earnout or some sort of economic tool that motivates owner to stay involved, to continue to help grow the company. I mean, that's generally speaking really the best you can do. I mean, we've abolished the 13th Amendment, so you can't force someone against their will to work for you and to do a good job. But you need to figure out how are you going to motivate them.
Now, is that typically what happens just in private equity? Typically everywhere
No,
that you have part of the sales a rollover?
it's increasingly common. I mean, it's the private equity model, but it's becoming more and more common across the board. And and even if it not specifically rollover, the idea of future compensation or a portion of your total possible purchase price being dependent on future performance of the business is extremely common.
Yeah, there's always some mechanics. Either you're going to do a compensation which is big enough for the owner to stay on, so you're incentivizing it that way, or taking a portion of the enterprise value of the company and holding back to it in one shape or form, whether that's equity or just a holdback, earnout. There's always going to be a certain holdback in different names of that holdback to keep the business owner incentivized, motivated to stay on.
Yeah, and you know, just to build on that point, one of the things I always stress when we're on the sell side is that the number that matters by far the most, and sometimes is the only number that you should care about, is the cash payment at closing. What the amount of money that you're putting in your pocket at closing that, you know, is not subject to future performance, not subject to contingency, um, not being held in an escrow. That's the most reliable purchase price that you can count on. Everything else you kind of have to view as a maybe. And if the amount of that you're getting at closing is not worth it for you to sell the business, then you need to strongly think about whether or not it's worth doing, because you can't rely on the earnouts hitting. You can't rely on, you know, my rollover equity is going to become valuable in a second exit. It very well might be. It very frequently does, but it's, you know, it's not something that you could take to the bank.
Got it. Thank you. All right, we got one more question and then we will jump. Can you demand partial seller financing for the finance for that matter?
Demand is a strong word.
You could demand
Is
whatever
that
you want.
typical?
Other, you
You
know,
could request.
it's a bilateral agreement. They have to agree to it. But you know, seller financing again, it's another tool that is used to bridge gaps in valuation, bridge gaps in available capital to buy out the seller, and also gives sellers some skin in the game about the future performance. If 10% or 20% of my purchase price is tied up in a note, then it's very important to me that your business will continue to perform well after closing, because I am no longer the owner of the business. I'm now essentially a lender of the business. And just like a bank wants to make sure that they are lending money to a healthy business that will be able to pay them back, same thing with a seller. Just because you used to be the owner doesn't change that calculus.
All right. Thank you, everyone who joined us today. Thank you especially to our three guests, Mendel, Rick, Av. It was great to be here and chat with you today, and hope to see you all back again sometime soon.
Very good.
Thank you guys for putting this together.
All right.
All the
Thank
best.
you. You're welcome.
Bye-bye.
Bye.